All right, let's continue this conversation from credit cards to loans. Just because the Federal Reserve is expected to cut interest rates next week doesn't mean you'll get a deal if you wait to take out a longer-term loan. Joining us now to discuss is Kelly Shue, who is the professor of finance at the Yale School of Management here. Great to have you here with us. So first and foremost, you heard our discussion there just a moment ago. How should people with outstanding loans be preparing for this potential rate cut coming in September?
Thank you, Brad, for inviting me here. I did want to just bring people's attention to this idea that what my research shows is that it is a mistake to wait until an expected Fed rate cut to actually go and take out a long-term loan. And the reason is the interest rate on any long-term loan is forward-looking. The interest rate on long-term loans, such as mortgages or long-term personal loans, they have already dropped to factor in market expectations that the Fed is going to lower interest rates this month. So unless there's a surprise in which the Fed lowers interest rates more than markets expected, the interest rates on mortgages and other long-term personal loans are not going to fall further. They've already dropped. So there's no reason for households to wait.
And with that in mind, what type of loans most notably are going to have the impact that you're talking about, where even if we do see rate cuts and a pathway forward for continued rate cuts, the loans that won't have any type of net or delta from today versus if you were to take out that loan 2 months from now?
So any type of long-term loan, I would say a year or longer, expectations of Fed rate cuts have already been priced in. Basically, the bank on the other side offering us these loans, they have the same information that we do, that the Fed is going to lower rates. They've already priced that into the interest rate of long-term loans. Now, it is true if you're going to get a short-term loan, for example, a credit card with a variable rate tied to the prime rate, that could actually drop after the Fed cuts rates.
Okay, and so with that in mind, you have a lot of people that are trying to figure out how this also might impact their mortgage rates, and if they're going to apply for a mortgage rate, whether they should do it now versus when the Fed starts to cut rates. What is the thinking going into the approval process, or at least the applicant process for those rates, and waiting versus not waiting?
In some ways, I think the rational, correct way for consumers to behave is actually not to worry about timing interest rate markets. And that is because the current interest rate in the market for any long-term loan already reflects all the information we have about what the Fed is likely to do in the future. And therefore, for example, if you think that the Fed is going to raise interest rates, there's no reason to rush in and get a mortgage now before the Fed raises interest rates, because interest rates have already risen on the news that the Fed is likely to increase rates. And similarly, now that we're in a cut cycle, there's no reason to wait to get a loan until the Fed actually goes out and cuts rates. Long-term rates have already fallen. Okay. Now, this actually means the job of a typical household is actually much easier. Just don't worry about the timing. All of the information that we have has already been priced in.
Okay, and so with that in mind now, looking ahead to the monetary policy, what are your anticipations for the size of a cut we could get, and then ultimately what that spells out about the economy too, because that still has some larger implications for the amount of loans that people might feel like they need to get to stave off any hit to their own financial balance sheets?
I tend to believe what the Fed is saying. The current Fed has a good track record of giving us pretty reliable guidance. They're hinting at a rate cut. I would be surprised if it were a 50 basis point rate cut. That's probably larger than what they're going to do, but it's a possibility.
All right, Kelly Shue, who's the Yale School of Management professor of finance. Great to have you here on the program with us. Thanks so much for the insights.
Thank you, Brad.